Welcome back to Chapter 2 of our series, From Chaos to First $1,000 Paid Off. In this episode, titled Decode Interest Rates, Understand Costs and Minimums Fast, we're going to break down APR in plain English so you can make sense of those numbers and know exactly what you're paying. Let's dive in. Your credit card company knows how long it'll take you to escape your balance, down to the month. You probably don't. A single reasonable interest rate can quietly turn a few $1,000s into thousands more. In this episode, we'll decode how that happens, step by step. Most people know their interest rate, but not what it quietly does to their balance month after month. There's a big difference between a reasonable 18 to 22% APR on paper and what that really costs over years of payments. In this episode, we'll zoom out from a single card and look at the system you're up against. Lenders don't just pick a number and hope. They design minimum payments, fees, and timelines to keep your money working for them as long as possible. With U.S. households carrying over $1 trillion in credit card debt, even a small tweak in rates or minimums adds up to billions, fast. We'll break down how APR, fees, and minimum payments interact, why tiny changes in rate or payment size matter, and how to flip those mechanics so they finally work in your favor instead of against you. Here's the twist most people miss. The same rate and balance can cost wildly different amounts depending on timing and structure. Interest doesn't just care about how much you owe, but also how long and in what pattern. That's why two people with $5,000 on cards can end up with totally different totals paid. One glides out in a few years, the other trudges along for a decade. Think of it like weather systems. A small shift in wind early on can steer a storm hundreds of miles off course. A tiny change in your behavior now can similarly reroute your payoff path. Think about what your lender actually controls. They set the rate, the rules for calculating charges, and the formula for that minimum due. You control only 3 levers: how much you borrow, how fast you pay, and how often you let a balance sit. Let's start where most statements quietly work against you, the minimum formula. A common setup is 2% of balance or $25, whichever is greater. On a $5,000 balance at 22% APR, that first minimum might be about $100. Sounds decent, until you realize most of that is just covering the cost of carrying last month's amount. The part that hits the actual balance is small, so the next month the calculation barely shrinks. The lender gets consistent income, you get a very slow exit. Now flip one lever at a time and watch what changes. Fix your payment instead of letting it float. Commit to $200 every month on that same $5,000 instead of following the sliding minimum. You're forcing more of every payment toward what you owe, not what you're being charged. Add an automatic raise to your payment. Each time your required minimum drops, keep paying the old, higher amount. That turns their design, shrinking payments over time, back on itself. Attack new charges separately. If you must use the card, treat new spending as a different bucket. Pay every new purchase in full monthly and aim your extra cash only at the old balance. Otherwise, you're mixing today's expenses with yesterday's decision, and the older, high-cost portion lingers. This is where the compound interest formula stops being abstract and starts being practical. The variables you can move are P, the amount you let sit, T, how long you let it sit, and indirectly R, by refinancing or shifting to cheaper products when you can. Move any one in your favor, even slightly, and the long-run numbers change a lot. Move 2 or 3, and the whole curve of your payoff timeline bends sharply downward. Your goal isn't perfection. It's to stop passively accepting the default settings and start deliberately choosing your own. Think of variable rate debt like unpredictable weather on a long hike. You can't control the storm fronts, but you can absolutely control your route, your gear, and when you choose to move. A rising rate is like a sudden headwind. It doesn't change the distance, but it makes every step cost more energy. Here's where this matters in real life. When the Fed nudges rates up by just 0.25 percentage points, cardholders collectively pay around $1.6 billion more per year. That's not abstract. Banks know how those extra dollars appear. They flow from small balances sitting just a bit longer than planned, or from people who only slightly underpay compared with a fixed payoff schedule. You can use that same precision in your favor. Pull up a reputable payoff calculator from the CFPB or a major bank and plug in your numbers with 3 scenarios: your current payment, a fixed higher payment, and a stretch payment that feels challenging but possible. Then compare total cost and months to freedom. The gaps between those lines? That's the dollar value of your future decisions made visible. Rate changes won't just tweak your bill, they'll reshape how money behaves around you. As AI-driven pricing spreads, your offers may shift week to week, like surge pricing for borrowing. Digital wallets could surface a true cost line beside every Buy Now button, turning each tap into a mini negotiation. If CBDCs arrive with purpose-based rates, you might one day choose between a cheap but restricted loan and a flexible but pricey one, demanding sharper judgment, not just more data. Treat this like learning a new instrument, awkward at first, powerful once your hands know what to do. Next episode, we'll turn raw numbers into a simple debt playlist that tells you which balance to hit first and which can wait. As rates and rules shift, that ranking becomes your map, so you're reacting with intention instead of surprise. Try this experiment. Pick one credit card or loan and calculate the real monthly dollar cost of its interest using its APR and your current balance. For example, $3,000 balance at 24% APR, approximately $60 a month in interest. Then, log into your account and test how changing your payment to exactly 2 times the minimum would change the interest you pay over 12 months using the issuer's payoff calculator or an online one. For the next 30 days, actually pay that 2 times minimum and track how much less your balance grows compared with last month's statement. At the end of the month, compare old pattern versus 2 times minimum in dollars of interest paid, and decide whether locking in this higher payment feels worth the real observed savings. This was Owl Up, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!